Welcome to this deep dive. We're jumping straight into the Q3 2025 earnings for Norwegian Cruise Line Holdings, NCLH. Now, if you just glanced at the headlines or that stock chart reaction, and believe me, it was pretty brutal, you'd think, well, the company really stumbled.
Yeah, exactly. But when you start to, peel back the layers, look at the financials, the strategy they're laying out, it's actually a much more, let's say, complex and even conflicting picture.
It really is.
It's almost a textbook case of market divergence, isn't it? I mean, you've got management delivering really strong operational results. They even raised the full year earnings outlook, showed great cost control.
Yeah, impressive stuff on that front.
But then the other side, investors just zeroed in on one thing. That top-line revenue miss.
And that mismatch, that one number, seemed to trigger this huge sell-off. So I guess our mission here is to figure out, well, why did the street choose fear over maybe the fuller picture?
Exactly. Let's unpack it.
Okay, so basics first.
Yeah.
Let's hit the numbers. Profitability adjusted EPS came in at a $1.20. That beat the consensus, which was around $1.16. So, a clear win on the bottom line.
Check that box.
And operationally, occupancy was fantastic. They hit 106.4%. That was actually ahead of their own guidance.
Yeah, genuinely a record-breaking quarter from an operational standpoint. Adjusted EBITDA was just over $1 billion, $1.019 billion. They weren't kidding when they called it their best quarter ever.
Okay, so strong operations, profit beat. But then the revenue.
Yes,
Yeah.
The sticking point. Revenue landed at $2.94 billion. The expectation, the street's number, was closer to $3.03 billion, so a miss.
And that miss, that single number, sparked a really sharp sell-off. We saw it dip down, around 15% negative at the lows?
On huge volume, too, something like 4 times the average daily volume. We're talking 56 million shares traded. That's serious money moving out.
Yeah, institutions heading for the exits. So profit beat, revenue miss. The obvious question is, how do you miss revenue when demand and occupancy are supposedly so strong?
Right. And that leads us straight to the core strategy they talked about. This wasn't an accident, according to them. Management basically said this was an intentional trade-off, yield versus load factor. They prioritized filling the ships, getting that 106.4% occupancy, even if it meant the average price per guest, the yield, took a bit of a hit.
Okay, so fill them up, even if it's slightly cheaper per person. Volume over immediate price.
Mm-hmm.
But hang on, if Q3 demand was that strong, you mentioned the Caribbean families on the NCL brand.
Mm-hmm.
Why did they have to dilute the price? Couldn't they have just held prices firm and still filled the ships with that kind of demand?
Well, it's about the mix of guests. It's sort of a mechanical dilution, and they see it as strategic. The strong demand, particularly for those shorter Caribbean runs, was heavily driven by third and fourth guests in a cabin. Think families, kids.
Oh, okay.
And those third and fourth passengers, they always book at much lower price points than the first 2 adults in the room. That's standard. So you fill the ship, which is great for utilization and ancillary revenue, but it just naturally pulls down your blended average ticket price.
I see. So it's not that the first 2 passengers were paying less necessarily. It's that the average was dragged down by bringing in more of those lower priced third and fourth berths.
Precisely. That mix shift is the key because they leaned into that family volume. Their net yield growth, which is the real measure of pricing power, only came in at, plus 1.5% on an as-reported basis?
Right. And the market sees that 1.5%, compares it maybe to competitors, and thinks, pricing weakness. Panic sets in.
Exactly, panic. But management's framing it differently. They see it as, look, we're bringing these future customers, often younger families, into our ecosystem now. We're locking in high occupancy, building loyalty, setting the stage for better margins down the line. It's an investment.
Prioritizing volume today for maybe potentially higher wallet share tomorrow.
That seems to be the play.
And looking at their guidance, it sounds like they're sticking with this approach. Q4 adjusted EPS guidance around 0.27 cents, maybe a touch below what some hope for.
Yeah, bit soft maybe.
But they're still guiding for net yield growth in Q4 of 3.5% to 4.0%. So still focusing on getting that volume, even if yield growth isn't maybe shooting the lights out immediately.
And what's really interesting, despite that near-term yield pressure, they actually raised the full-year outlook.
That's the counterintuitive part, right?
Totally. They bumped up the full year 2025 adjusted EPS guidance to $2.10. It was $2.05 before. And they held firm on the adjusted EBITDA guidance of $2.72 billion.
So the underlying profit engine is strong enough to handle this mix shift and still predict higher overall earnings for the year. That speaks volumes about cost control.
Absolutely. That's the other crucial piece. Let's talk efficiency, because honestly, this is where NCLH seems to be really nailing it.
Okay.
If you look at their costs, stripping out fuel that's adjusted net cruise costs ex fuel, ANCC ups fuel for short,
Okay.
they were basically flat compared to last year.
Flat in this inflationary environment. That's pretty remarkable.
It's a huge advantage. They're super focused on this cost savings program, aiming for over $300 million. They already banked over $100 million last year, on track for another $100 million plus this year.
Right.
And crucially, they committed to keeping cost growth below inflation into 2026. That's discipline.
That kind of cost control is what lets them hit that, 36.7% adjusted operational EBITDA margin over the last 12 months, even with the yield stuff.
Exactly. It shores up the profitability.
And it seems the demand pipeline backs up this operational strength. They said Q3 bookings were the best third quarter bookings they've ever had.
Yep. Strongest in company history, up over 20% compared to last year. That's a big number.
Wow. 20%.
Yeah.
And that momentum apparently carried right through into October as well.
Yeah, they said it continued strongly, driven again by the Caribbean focus, but also continued strength in their luxury brands Oceania and Regent. Those segments seem really resilient.
So the demand signal is flashing green across the board, really.
Pretty much, which makes that market sell-off feel, well, incredibly short-sighted when you stack it against the actual business health and forward bookings.
It really does.
Oh.
Especially because it feels like the market might be ignoring some massive improvements they just made on the financial structure side. You know, the operational story is one thing, but if the balance sheet's shaky, the market gets nervous.
Oh, good point. Let's talk about that September capital markets deal. That was a really big cleanup operation.
Yeah, explain that a bit.
Okay, so it was pretty complex multi-part deal. They refinanced about $2 billion in debt. But the really strategic part, I think, was that they completely eliminated all of their secured notes.
All secured notes. What does that actually mean for them?
It means they have more flexibility. It
Yeah.
frees up assets, improves their collateral position, gives them a stronger foundation. It's not just pushing debt maturities out. It's fundamentally improving the quality of their balance sheet, building that fortress, you could say.
And there was a shareholder benefit too, right? It wasn't just about debt.
Correct. Big benefit. They also managed to reduce their fully diluted share count by over 38 million shares through related transactions.
38 million. That's about, 7% of the total shares outstanding?
Roughly, yeah. Around 7%. And that's immediately accretive. Future profits get spread over fewer shares, so EPS automatically gets a boost down the line.
Okay, so better debt structure, fewer shares. What about the overall debt level, the leverage?
Well, even with taking on some debt for a new ship delivery, the net effect of the refinancing was pretty much neutral on leverage right away. They ended Q3 at 5.4x net leverage.
Still high, but neutral after the deal.
Right. But the key is their target. They're firmly aiming to get that net leverage down into the mid-4 times range in 2026. So deleveraging is clearly a top priority alongside the cost savings.
Okay, so financially getting stronger. Let's pivot back to the commercial side. Where is this volume strategy playing out most obviously?
It's really visible in the core NCL brand, especially that push into the family market using shorter Caribbean trips.
Right, you mentioned that earlier.
Yeah, and the numbers are stark. For Q4, their capacity on those short Caribbean sailings is up 80%, 80, compared to last year.
80% increase. Wow. Okay, so that's the tactic driving the immediate occupancy boost and, well, also the yield dilution we discussed.
Exactly. And this increased Caribbean focus isn't random. It feeds directly into their big bet, the huge investments they're pouring into their private island, Great Stirrup Cay GSC.
The private island. That's becoming a bigger and bigger deal for all the cruise lines.
It is. And for NCLH, GSC seems like the linchpin for unlocking future pricing power.
Right, they're building a lot there. A new pier, I think, a big pool.
Yep, the pier and a large pool area are supposed to open around the holidays this year. But the main event, the really big addition, is the Great Tides Water Park. That's slated for summer 2026.
Okay, a water park. Sounds fun, but how does that translate into financial results? How did that fix the yield issue?
It's about changing the value proposition. Private islands are high-margin destinations. People pay extra for experiences there. By massively upgrading GSC's capacity and appeal with things like a huge water park, they're creating a much more compelling, differentiated product.
So the idea is get the families hooked now with the increased sailings.
Right, build the volume, get them familiar with the brand, maybe get them onto the island before the big stuff opens.
And then, once the water park and everything is fully operational in 2026, you've got the demand locked in, and you can start pushing prices higher because the destination itself is worth more.
That seems to be the plan. Maintain high load factors, they're talking at least 105% in 2026, and then layer on price increases as the enhanced GSE comes online. Get the volume now, monetize it fully later.
Makes sense. And while the main NCL brand is doing this repositioning dance, the luxury side is holding steady.
Yeah, Oceania and Regent are performing well. That affluent customer base seems very resilient, less impacted by broader economic concerns. It provides a nice, stable base.
And they did something with loyalty programs recently too, right? Trying to link the brands.
Yeah, they launched a cross-brand loyalty status program. Basically, if you have status on, say, Regent, you get recognized with perks when you try Oceania or even NCL and vice versa.
Oh, interesting.
It's a smart, pretty low-cost way to encourage loyal customers on one brand to try the others. Deepens the relationship, potentially increases their overall cruise spending within the NCLH portfolio, maximize that lifetime value.
Okay, so if we try to tie all these threads together, you've got disciplined cost cutting, major balance sheet improvements, record bookings showing strong demand, and this strategic shift towards Caribbean volume now, setting up for higher margins later with the Great Stirrup Cay investment.
Yeah, when you lay it all out.
The path seems pretty clear, right?
Yeah.
Take some near-term yield pain for the load factor, build towards that big margin expansion in 2026. They're targeting, what, a 39% adjusted operational EBITDA margin?
That's the target, 39% next year. It's ambitious, but they've laid out the steps. Cost control, GSC, leveraging the volume. It's a clear roadmap. And yet, despite all this, NCLH stock has really lagged behind the S&P 500, even its travel peers, over the past year.
Significantly underperformed, yeah. And that gap, combined with this latest Q3 sell-off, well, that kind of sets the stage for our next segment, doesn't it?
It certainly does. Okay, let's shift gears. Time for our This Is Not Financial Advice segment. Imagine we're pitching an idea to an investment committee, purely hypothetical, for discussion and analysis only.
Disclaimer noted.
Given everything we've just unpacked about NCLH, what's the outrageous but plausible trade idea?
Okay, here's the pitch. The core thesis is simple. The market is completely misinterpreting the Q3 results. It's getting fixated on a revenue miss that was arguably self-inflicted for strategic long-term gain.
So irrational pessimism.
Deeply irrational, we'd argue. It's ignoring the triple threat of 1, relentless cost discipline, 2, that huge balance sheet optimization, getting rid of secured debt, buying back shares, and 3, a clear funded strategy to drive high-margin occupancy with GSC in 2026.
Okay, that's the thesis. What's the trade itself? How do we play it? The trade idea is go long NCLH shares, buy the dip, essentially. But to make it a bit more interesting, maybe pair it with a short position on one of the competitors, say a Royal Caribbean or a Carnival, companies that have maybe shown stronger near-term pricing, but might not have the same structural improvement story NCLH is building.
Ah, a pair trade. Long NCLH, short a peer. Betting on convergence.
Exactly. You're betting that the market has unfairly punished NCLH relative to the others. The core bet is on NCLH's strategy, that charting the course plan. Specifically, can they keep delivering on costs? Sub-inflationary for year 3. Can they hit that deleveraging target?
Right.
If they can, we believe that combination, plus the GSC ramp-up really kicking in during the second half of 2026, will lead to superior earnings growth for NCLH compared to peers, closing that valuation gap.
So you're essentially saying the market's focused on the temporary yield dilution today,
Yep.
while ignoring the permanent benefits of a 7% share count reduction, structural cost savings, and the future margin boost from GSC. You see future accretion where the market sees current weakness.
That's the arbitrage, precisely. The market's playing checkers, NCLH seems to be playing chess. The runway looks clear if you look out a bit further.
That is definitely a confident pitch for the committee. Okay, so let's just wrap this up for you, the listener. NCLH delivered a solid operational quarter, beat EPS estimates $1.20, and even raised their full-year profit guidance. That's the good news. But their strategic choice to prioritize filling ships, now especially with families on Caribbean routes, meant average ticket prices, yield, didn't grow as much as expected. This led to a revenue miss.
And that revenue miss, despite the profit beat and raised guidance, is what seemed to spook the market into that big sell-off. They focused on the yield dip, maybe overlooking the long game with Great Stirrup Cay coming in 2026.
Right. So here's the final thought, the provocative question we'll leave you with.
Considering those record Q3 bookings up 20% year over year, and the significant reduction in shares outstanding, plus the elimination of all that secured debt, is this double-digit stock drop truly justified? Or is it an overreaction to a short-term strategic trade-off that actually positions them better for the long run?
That's the key question you need to wrestle with. Thanks for joining us for this deep dive into NCLH's Q3 results. Hopefully this discussion helped put the market's reaction into context and shed light on the company's, well, complex but clear long-term strategy.